This LOS is describe types and characteristics of residential mortgage loans that are typically securitized. Residential mortgage loans. A mortgage is a loan secured by the collateral of some specified real estate property that obliges the borrower to make a predetermined series of payments to the lender. So the cash flows of a mortgage include 1. Interest, 2. Scheduled principal payments, and 3. Prepayments, any principal repaid in excess of the scheduled principal payment. So when you're paying back a mortgage, it's usually a flat monthly amount, and that's a combination of both interest and principal repayment. With some mortgages, it's possible, if interest rates are going down, to make prepayments to reduce your principal and pay off the loan more quickly. Okay? So the various mortgage designs throughout the world specify 1, the maturity of the loan, 25 years, 30 years. In Canada, at one point, it was possible to get a 40-year loan. 2, how the interest rate is determined, i.e. fixed rate versus adjustable or variable rate. 3, how the principal is repaid, i.e. whether the loan is amortizing, and if it is, whether it is fully amortizing or partially amortizing with a balloon payment. 4, whether the borrower has the option to prepay, and if so, whether any prepayment penalties might be imposed. And finally, 5, the rights of the lender in a foreclosure, whether the loan is a recourse or non-recourse loan. Okay, we're just going to finish this LOS with one practice question. This is not a big LOS because the next one is describe types and characteristics of residential mortgage-backed securities, including mortgage pass-through securities and collateralized mortgage obligations, and explain the cash flows and risks for each type. So this LOS is just looking at some of the characteristics of residential mortgage loans, so it's very short. Anyhow, in an interest-only mortgage, the borrower A does not have to repay the principal as long as she pays the interest. B does not have to make principal repayments for a certain number of years, after which she starts paying down the original loan amount. Or C does not have to make principal repayments over the entire life of the mortgage and pays down the original loan amount as a balloon payment. So that was a nice question to end on. In an interest-only mortgage, the borrower does not have to make principal repayments for a certain number of years, after which she starts paying down the original loan amount. So B is correct. In an interest-only mortgage, there is no scheduled principal repayment for a certain number of years, so the borrower starts paying down the original loan amount only after initial period of interest-only payments. Some, but not all, interest-only mortgages do not have scheduled principal repayments over the entire life of the loan. These mortgages are called interest-only lifetime mortgages or bullet mortgages, and they require the borrower to pay back all the original loan amount at maturity. And that's the last slide for this LOS. Thank you.